Hello, everyone, and welcome to the Weiss Financial Literacy Podcast, where we break down financially complex topics into bite-sized, digestible pieces. It's our goal to provide educational content to help the average person increase their financial literacy, starting from a basic discussion, breaking down terms and jargon to help you have a concrete idea of the concepts. I'm a residential loan officer at Fairway Independent Mortgage Corporation. My NMLS number is 263293. I'm licensed in 21 states, and what we're discussing here today really specifically applies to our friends, families, and clients who reside in Arizona. Although I feel the topics covered today will apply throughout the United States, it is definitely our desire to help educate uh, people and uh, get these topics covered in a way that really, adds value to your understanding of money, your management of money. We'd certainly like you to make more money, have it grow, or at least keep more of it. Joining us today, of course, is Mr. Seth Fink, certified public accountant. Seth is a principal at Focus Financial or Focus Accounting and Tax Specialist, PLLC, located in Phoenix, Arizona. His wisdom and expertise and ability to break down these complex topics is really why I've had him join us today. You're going to learn quite a bit today. And even if you think you have a great handle on taxation, I think you're going to be very much surprised at things and some pickups that you're going to gain. We're also going to work hard not to put anybody to sleep. We know the topic itself of taxation can be somewhat daunting, but since it's so important to every American, we really hope that you can hang in there with us, and we're going to try to add some energy and lighten some of the topics so that you can really dig deep and understand it in these bite-sized pieces. Since we're doing several episodes as well, please stay tuned. If one of them is not applicable to you, please feel free to fast forward and jump to one that really does seem to apply to you or have more applicability to your situations. We will be building in complexity to help you understand more of the options at a deeper level as we progress. So welcome, Mr. Fink. How are you today?
Hi, Carl. I'm wonderful. How you doing, sir?
I am great. Thank you so much for joining us. I guess let's start off with something pretty straightforward and easy. Can you please, help everybody? We're going to try to keep everything really, really basic without talking down to anyone, but I want to get rid of a lot of the jargon and the terms because we throw that stuff around every day and we kind of know what it means in the financial circles, but not everybody does. So can you tell our audience what a CPA is?
CPA is a certified public accountant, and in our role, there's lots of different things that we could do. The CPA works with companies helping review and create financial statements, doing accounting and accounting support, advisory services. In our particular case, we are a tax and consulting firm. So our work is our CPAs are specialists in taxation, tax strategies, tax advising. So that way we can help clients get as tax efficient as possible, helping, review their situation, whether it's a business owner or an individual, putting them in the best possible place, that we can, and create efficiencies within their, taxation structure.
And that's great. So are there different types of tax professionals?
Oh, for sure. The majority of tax professionals you're going to find out there are not licensed. They might be enrolled agents, they might be CPAs. Most tax professionals are what we call historians. So their goal is to take your data, take your information, prepare a tax return that they think is credible and well done, and we'll see you next year. In our particular case, our firm, we work as tax advisors. So our engagements are all built on an advisory basis, meaning we're more focused on today forward, being a competent and good historian and creating, very well thought out tax work is super important, but there's a bigger importance on the planning process, taking you today forward. You should know what your taxation results are going to be before you even prepare your tax return. And for our clients, that's what we work towards, understanding the variables, understanding the options, helping plan for what kind of deductions, for what kind of retirement contributions, all those sorts of things to put those taxpayers in the best possible place. So it's really a big range of services in the tax professional world where fewer are like us that lead with the advisory part. Primarily, you're going to find people who are just historians and tax preparers.
Okay, and so you mentioned a couple of different types of tax professionals. You mentioned an enrolled agent. What is what is that? And is there education as a component to that kind of career?
Got it. So an enrolled agent is a licensure that's actually created by the IRS themselves. You have to pass a rigorous three-part examination. And then by passing that, you're actually allowed to practice in front of the IRS. You can represent a client under audit, all those sorts of things. If you're an unenrolled preparer, you can only represent a client if you prepared the return, but the client has to be present if you're not licensed. CPA being a certified public accountant, different from an enrolled agent, it's a state licensure. It's a federal examination controlled by a state by the American Institute of Certified Public Accountants, but the licensure requirements are different state by state. But the CPA covers not just taxation; it covers complex accounting issues, GAAP accounting, generally accepted accounting principles, all sorts of additional things. So it takes tax as one part, but expands upon it and more of the financial and business law and audit and all those other disciplines.
So if you were to have a hierarchy, it sounds like, when we hear the term accountant,
Mhm.
right? Which may or may not be, a licensed individual or, kind of on the in the realm almost of a bookkeeper, right?
Right,
And
right.
then as you go up the ladder in terms of, complexity, licensure, and competence, you may go up the next layer up above that might be that enrolled agent.
Mhm.
And then the top of the hill is sort of the CPA.
Right.
Is that a fair way to describe it?
It's fair, but a lot of enrolled agents are not accountants. They're just tax professionals. That's where they focus. So you're kind of looking from a hierarchy standpoint. You have your data entry specialist, then you have your bookkeeper, right? And then you
Okay.
have accountant, because the accountant is a higher skill set than just a bookkeeper. Bookkeeper's handling paying your bills, doing your deposits, maybe reconcile the end of the month, may or may not really understand financial statements. An accountant understands financial statements, reviews those statements, helps business owners understand those. And then the CPA is kind of on top of that. The EA enrolled agent kind of look at it as on the side because it's
Okay.
specifically a tax related designation where CPA is all encompassing.
Gotcha. Okay, great. I think it's just nice for people to have because people throw terms around a lot, right?
Mhm.
And knowing where they are or what they are, I think is important for people to understand, if they're out there looking for someone to assist them in filing their taxes as to maybe what kind of person that they want to, gear that towards. And of course, and along the line, a lot of things are going to come into play, right? There's going to be a cost differential, right? When you use a higher end professional, it's often, more expensive on the front side. Of course, you can't take into the account the long-term side of that because someone who's less expensive who makes a mistake could be far costlier than someone who initially was,
Right.
more well qualified and maybe charged a little more up front. Um, and in full transparency, obviously, you've been my accountant for, I don't know, 20 something years probably. Um,
Actually, this year will be the 20th year
this is
because
our 20th anniversary. That's
yeah,
fantastic.
yeah,
Um,
yeah.
and so, knowing that and having worked, with dozens of other accountants and CPAs around the country, one of the things, that's obviously led me, to you and really just kind of embrace um, the engagement, I would say, with the firm is your knowledge and your ability to really boil down some of these complex topics, right? So again, very happy to have you on today. And one of the things that happens in the outside of maybe your world and the rest of the financial world is we have this kind of mantra, right? And it goes something like, well, I can't give you specific tax advice. Please check with your CPA. But
Mhm.
normally people in your circumstance do whatever, fill in the blank, XYZ, right? And so having you on today is great because while I have conversations with attorneys and financial planners and CFPs and all kinds of, insurance agents and other financial professionals, today we actually get to have the discussion of, well, how does it work for taxes, right? So thank you so much because it's going to be great that we actually get a real answer to some real questions that people actually have, right? Um, so when we discuss taxes, it's probably impossible not to ultimately at some point mention the Internal Revenue Service, or as we love to call them, the IRS, right? Why is it that we don't want to be in trouble with the IRS? what is it about them? Like, what can they actually do?
One misnomer is the IRS actually can't put you in jail for not paying your taxes. So that people think that all the time. So those wonderful scam phone calls people get saying we're sending the sheriff to you to arrest you because you didn't pay your tax. It's not possible. But the IRS can make your life pretty difficult. I mean, for whether it's evasion or failure to pay your taxes, they can go through a process to lien your bank accounts. Where on a systematic basis, they can just take the money out of your accounts if it goes through due process and they say, hey, you do owe this and you haven't paid us. They can lien your credit, they can lien your property. And they make your life difficult from a standpoint. You're at a financial standstill until you address those issues. I'm sure you've come across it where you have, people you're trying to get financed for a home and there's a tax lien on their credit and you can't get them financed until that tax lien is resolved. They go to people like me to try and get those tax liens resolved, and they're difficult. They are time consuming to get done. But for someone to have a tax lien, a lot of things have transpired to get there. They have
Yeah.
failed to respond, failed to get on a payment plan, failed to meet their obligations. It's about 10 steps into the process. They don't go straight to leaning your credit or leaning your property. They've given you lots and lots of opportunity prior to that to make payment arrangements, take if it's an audit, take it to appeals to make sure it's an agreeable result, all sorts of things like that. So, but they do have a lot of power to be able to make your financial life incredibly difficult if you're not in compliance. I tell people, think of them as your silent business partner, whether you're just an individual or you have a business, they are your silent partner with their hand out saying, give us our share.
Right. Yeah. And people don't get into trouble just by missing one letter, probably.
No, no,
There's probably more to it than that. In a lot of what we're going to talk about today is sort of maybe the overarching, the foundational part of taxation. We're really probably going to dive mostly into is federal taxes. Is that fair?
yeah.
And when we talk about the federal tax system in the U.S., can you just kind of explain how the flow of taxation works and maybe, give us a little example of what the progressive tax system is and how it really works for people? Because I hear comments that people make all the time, and I don't think people have a really good foundational understanding of what we say, air quotes, tax brackets all the time, right?
Right.
Can you break that down for us a little?
Sure. So a progressive tax system essentially means as your income goes up, your tax rate on that income increases. So every taxpayer gets a certain amount of income taxed at 10%, a certain amount at 12%, then 22%, 24%. So it's not like all of a sudden you make, $200,000 a year. I'm in a 32% tax bracket. It doesn't mean you're paying 32% tax on all your income. What it
Yep.
means is that tax bracket is the top rate you're paying. So you're paying a blend of tax rates based on your income. So you fill up each of those smaller buckets. So tax bracket is where have you achieved? Where are you at right now? What top tier are you paying taxes at? But your effective tax rate, which is far more important, is the blend. The effective tax rate is you divide your total tax into your total AGI, right? And that'll tell you for every earned dollar, what percentage of your income you're paying in taxation. So the two things are very, very different. But it's important to note in that progressive system that the more you make, the higher bracket you're going to get to. The less you make, the lower bracket you're going to stay in. But it steps up for everybody at the same pace. And it's broken down by the type of taxpayer. So a single person has the lowest amount of income at each bracket. Someone that's head of household, qualifying dependents, is the next step. And then married filing joint, you get the maximum amount in each of the brackets before you move up to the next
Okay.
one.
Good. Yeah, that helps. And I think that's important because, a lot of times people will say, well, I want to be in the lowest tax bracket. And my common response is, no, you don't, because you'll be broke.
Yeah.
You want to be in the highest tax bracket you possibly can be because of
Mhm.
what you just explained, that average, that marginal tax bracket, just because your top dollar might be in the 32% bracket, but your average may be 17.
Right, exactly. And you think about it, if everybody had to pay $1 million in taxes, it means you're making more money than you know what to do with.
Right.
So it's a good problem to have,
Right.
but there is the idea of diminishing returns. When someone's at the top tax bracket, every additional dollar they earn is really
Mhm.
heavily taxed. So I have that conversation with clients all the time where maybe the taxpayer has a strong enough W-2 that they're in the 37% tax bracket. And then the spouse gets a little side job and maybe it's a Schedule C, but everything is being taxed at that bracket because it's just layering on top. So it's almost not worth it for them to earn additional revenue. So
Right.
there's an argument there over how that presents.
Yeah, and I know that we're gonna build on this because I have lots of specific questions, but we the concrete that we're pouring for this foundation hasn't cured yet. So we'll be jumping back to that because I've got some specific things that I hear very often as it relates to fixed income and taxation in that vein. For regular people, just normal, a couple with let's just say that they have a W-2 type job. Um, a lot of times I hear the thing where they'll think that all of their money is being taxed, right? All of their income. And so I'd like, maybe some understanding and some help walking us through, and maybe in a future episode, we could actually pull up a blank return and some charts to show people, but just in case they're driving or whatever, like to verbally go through it, or if they're watching, um, can you kind of help us understand how, you know, a couple who has earned income, how much of their real money is actually being taxed?
Great question. So the thing to remember is for every single taxpayer, you either have the opportunity to have a standard deduction or itemized deductions. And what those do is those reduce the amount of your income subject to taxation. So a married couple gets a standard deduction now of about $27,900. So if that married couple you're talking about with W-2 income, let's just say they make $100,000 a year. Okay. And they don't have enough itemized deductions to itemize. They get the standard deduction at 27.9. That would mean that they are paying taxes on $72,100, not the full $100,000 of taxable income,
And
right?
everybody gets that standard deduction, Seth?
Everybody gets a standard deduction. So, like I was saying, depending on your tax classification, whether you're single, head of household, or married joint, there's a different number of what that
Okay.
standard deduction is. And that's how much off the top you will not pay income taxes on,
Okay.
right? So,
And if we expound on that, then I guess the next kind of logical question is, um, how much do we even need to make to file a return?
as a W-2 earner, you have to make over the standard deduction, which is 12,000. It's like 12,800, 12,900. I don't have it memorized. That's the amount over what you have to file. Now, some states are different than the federal. In the state of Arizona, they do conform with federal, so it's the same standard deduction. Some states, the standard deduction is lower. So you
Oh,
have to know your state and understand, do they conform with the federal regulation or not? And some do, and some don't. So if you have W-2 income, you're an Arizona resident under that $12,000 and some cap, you don't have to file. Now, you'd only file then to get your any withholding taken out of your paycheck back as a refund. And the important thing to note here is if you are a self-employed person, let's say you just have all 1099 income where you're not being paid a wage, you get paid via check and you get a 1099 at the end of the year saying, here's your non-employee compensation.
mhm.
Anything over $400 requires a tax return. And that's because even if your income is $10,000, well, I'm below the $12,900 filing threshold, so I don't need to go ahead and file a tax return. Well, that's not true because as an independent contractor, anything over $400 is subject to Social Security and Medicare. We call it, either payroll tax, but in case you're self-employed, it's self-employment tax. That's 15.3% of the net income on your self-employed business.
Wow.
You may have no income tax, but you still pay self-employment tax, so you still have a filing requirement
It's
to pay.
interesting.
Mhm.
Okay, so to recap that, and I think we're going to get a little deeper into the classifications of the types of forms and what earned income is. Um, so to summarize that, whatever that standard deduction is, let's just say it's the 12,900-ish. Um, an individual taxpayer who doesn't make that on a W-2 is not required to file.
Mhm.
Um, However, there may be advantages to them filing, it sounds like, if they had withholding and maybe
Yeah,
they'd be in a position to get let's say, some of that withholding back because of their
Yeah.
standard deduction, right?
Exactly. So, I mean, if the thing is, you have to kind of look at what's the cost of doing it, right? So, if you
Right.
file your own tax return, you are looking at, just the cost of your tax software, or if it's, the free IRS service, right? So, if you're not using a professional, it costs you nothing. You'd want to go and get that withholding back, right?
Okay.
Um, the But there are, clients that look at us and say, "Oh, my child had 10 grand of income, but they
Mhm.
only had $200 withholdings." It's like, well, the cost benefit there. So I'll walk them through how to prepare it themselves, so they're not paying any money to get it. So that's the
Okay.
benefit of filing if you're under. Actually, I was just looking for 2024. It's 14,600 for the standard deduction for a
Okay.
single individual. So,
14.6. Okay, good to know. I'll write that down to,
yeah,
because I may reference that again for the standard. And of course, that's just
right.
for an individual, not head of
That's for
household, not
individual.
married filing jointly.
Correct.
Um, okay, so and obviously just to kind of touch on it again, so if they're not earning a W-2, right? If they're 1099, right? If they're an independent contractor, which we're probably going to go into in a little bit of detail,
Mhm.
that threshold then drops really from 14.6 down to $400.
Correct.
And then some states, not Arizona, but some states may have a different threshold for the W-2 earners
Mhm.
below that. So you could be in a position in some states potentially where if you made $10,000 and that was the threshold of the state where you file a state tax return, but not a federal.
Correct.
Okay. Um, who do those forms go to? Like who gets like when a W-2 is issued from an employer, obviously the employee has access to that form because it's federally requirement, it's a federal requirement that it get mailed by whatever, January 31st or whatever.
Mhm.
Who else gets that?
So when a W-2 is prepared, it goes four different places. Number one, it goes to the taxpayer, the person earning the income, they get a copy. The IRS gets a copy for matching up to your federal tax return when you file it. The Social Security Administration gets a copy. That way they can track your Social Security benefit. And then your state gets a copy for verifying your state withholding.
So if you're in a position where you're not sure if you need to file and maybe you haven't because you're unclear of the rules and it didn't seem like you made enough money, it seems like there's a couple opportunities for someone out there to calculate that for you and send you a letter in the mail. Is that a fair assessment?
Right, absolutely. And
Federally or state, maybe
yeah,
not Social Security, but
right. I mean, ultimately, I tell people even if their income is below the threshold, file a return. Say, have it on record that you filed, right? Even if you're not getting a refund, even if you have no taxable income, but you got issued a W-2, file the return.
okay.
Yeah,
It's just a good practice as a safety measure, really, right?
correct.
Then they
And
can't say you didn't file
yeah,
because at least you filed.
right. And because the IRS and the state only know about the things that they've been told by your employer or by anybody else filing, tax documents on your name. I go through this a lot with my seniors, where they get to the point where they no longer have a filing requirement,
Mhm.
right? But they want to keep filing to stay in the system so they don't get that letter.
Okay.
And so most often they'll still file. Sometimes they stop. They say, I'm 86, I don't care. And that's totally okay. Uh, but it's just understanding what your filing requirement is a really big deal. So
Okay.
just to know it, when in doubt, file.
And I know we've kind of touched on this a little bit, through throwing out these terms, but we see a lot of these forms and these things that either come to us in an electronic format through our employment or in the mail. But can you kind of break down like what is a W-2?
So the W-2 is the form that's prepared by your employer or by your employer's payroll company, somebody that the employer has retained that is going to give a bunch of different pieces of information to the government. How much your total taxable wages are, how much your Social Security and Medicare wages are, and how much that withholding was, how much your federal and state income tax withholding was. It'll also include things like if you've contributed to a 401k, how much you've contributed through payroll deduction, how much you've contributed to your HSA account through payroll deduction. Um, if your employer provides health insurance for you, there's a disclosure for how much the economic value of those benefits were, right? Which that came about when we started dealing with the Affordable Care Act and all the health insurance reporting. That's when that got added to the W-2s, just so the government knows everything and can tie it all together.
Right,
So,
because there's so many different boxes on the W-2 form
mhm.
that which ones would you say, for an individual, taxpayer, what should they be really looking at, and how do they kind of get a handle on all the different boxes and figuring out, okay, well, what does all this mean?
I mean, probably to the average taxpayer, the most important thing is your federal taxable wages, because that's what goes on your tax return as your, counts towards your earned income, your federal and state withholding. If you're a tipped employee, there's another box on there, box 7, that is for tips that are subject to Social Security, because that's got a different place on your return.
Okay.
If you're a W-2 employee and you have dependent care benefits taken out of your paycheck, box 10 shows how much those were, and there's a special place on your tax return to marry that up. So those are all really important things. The
Okay.
other stuff is, it's important, but it's not going to go in your return unless, there's some special, circumstances where it actually could change the outcome.
Right.
So,
And I think, just looking at it from kind of a generic, the average Joe and Jane, right?
right.
What are they going to experience if they're doing this themselves, or they're playing with software, or they're, going to the library or getting some assistance and, filing for the first, second, third time. It's a little daunting looking at the W-2 because there's so much information on there,
Yeah.
and it's not intuitive, right? To say the
Yeah.
least. The next probably most common one that I see is that 1099 form, which is typically for somebody who's technically an independent contractor.
Mhm.
Can
Right.
you tell us about what that form has on it, and who those forms go to as well?
Certainly. So the 1099 for independent contractors got changed a few years ago. It's now called the 1099 NEC, which stands for non-employee compensation. That just has the total amount that you've been paid as an independent contractor that you will put on your tax return, subject to self-employment tax and income taxes. There's
Okay.
never going to be, not never, but next to never will be withholding. The only time there'd be withholding on that is if you've been a bad boy or girl and the IRS has told the person you're working for to be, you're subject to what they call backup withholding. Okay. There are other 1099s, and it's usually 1099 miscellaneous for things like rental income or income that's not considered earned income. If you win a prize, you win the lottery, get a $100,000 scratcher ticket, you're going to get a 1099. It's going to have this what's in called box 3, which is other income subject to income tax. But box 3, different from the 1099 NEC, does not generate self-employment tax.
Okay.
So those are all kind of the basics that people would see.
Cool. And then when we get a job, we're often filling out a different form, that W-4 form, right?
Mhm.
And what is sort of the purpose of that, and how can you advise people what they should look out for? Because that seems like an important one on the front end that can oftentimes lead to challenges by the time we get to the back end and the W-2's been issued, right?
Right, exactly. So the W-4 is the form that you complete that calculates your withholding. Now, they replaced this form 4 or 5 years ago, and it's far less intuitive than it used to be. You just answer a series of questions. Is this your only source of income? If you're married, are you the primary earner or the not primary earner, or you're about equal? And the reason they kind of figure that out is to estimate how much income tax needs to be withheld for federal tax purposes. What we do see often is that questionnaire you go through, even answering it correctly, will result in your federal income tax withholding being a little bit less than it needs to be. It happens more often than not. And so
Okay.
you have the option on the W-4 to add a standard amount on top of the calculated withholding. So you can say, do all that calculation and add $20 or $50 or $100 per paycheck to make sure that I have enough withheld at the end of the year. And every state has their own version of that withholding form. In Arizona, it's called the A4. And in Arizona, since we have a flat tax now, you just tell it what percentage of your federal taxable income to withhold, and it just withholds that percentage for the whole year. So that's much more intuitive. It's much simpler to calculate.
Right. And it sounds like so on the federal side, if you add additional,
Mhm.
Um, and the reason you would do that, right, is so that at the end of the year when you file your taxes, that you're not getting, hit with a larger bill than you expected, let's
Right,
say.
right.
Um, then that additional amount, just to be clear, is per pay period. So if you're paid twice a month versus biweekly versus weekly or monthly, that's a per paycheck
Right.
deduction, adding to that withholding.
Right. And really, the withholding process gives a taxpayer the opportunity to pay their income taxes in pro rata over the whole year. The tax code says you have to pay it in at least quarterly, but by the end of the year, you need to pay in 90% of your current year tax obligation or 100 or 110% of the prior year to be able to pay any balance due at the end of when you prepare your return without any additional cost of money and penalties and interest.
Okay.
So it's an estimator, right? And so it estimates high, it estimates low, or it could be right on. You just have to know that. So the withholding is not itself the tax, it's just the money you're having withheld to cover your tax bill at the
Right.
end of the year.
Cool. And maybe this is a good jumping off point for this segment. But I'd like to when we rejoin is sort of dive in a little deeper to some of the taxes that we see on the actual pay stub, because I think some of those are important. And I don't know that a lot of people understand sort of the significance of some of those. So stick with us and we will be back in just a moment.